Hi, and welcome to my channel. For those of you new, my name is Dave and I work in financial services. And these videos are a mixed journey towards financial freedom. They will cover financial products, they will cover financial well-being so you, like me, can reach your goals and aims sometime in the future. Now let's get into this latest video. Now this latest video is about my self-invested personal pension plan. I do a monthly review, so this is a review for November 2022. For those of you new, the plan is annual growth of 10% year on year. For 2022, we're looking for annual dividends of £4,000 and we were looking for a year-end value of £120,000. Now, so far during 2022, the portfolio has somewhat struggled, mainly due because of some global events. A lot of the markets are down 20% plus, shall we say, S&P 500, Nasdaq. The FTSE 100 is nowhere near them levels. And finally, we've had some kind of good month. During November, the FTSE was up 6.7% and our portfolio has been reflected in the valuations. So we started a month, which was worth £89,815. End of the month, a very nice figure of £98,492. A profit in the month of £8,677, our best month for the year. And the year to date, the portfolio is now only down minus 1.39%, but way off our targets of 10% for the year. Normal contributions went in, £200, and it was topped up by the government of £50 a month later, and promptly based in financial services, as we can see by the following chart. And normal providers' fees roughly stayed about the same, currently £13.86 during the month to run this pension plan. As we said, predominantly UK based. Look at the following chart. 85.49% is in UK and Europe. 12.79% is in US and Americas, and a tiny percentage at 1.71% is in Asia, but we will obviously look to increase that as part of some kind of new investment strategy during 2023. Now, it was a very quiet month for dividends. We received no dividends within our portfolio, but we only record the dividends across our shares. We don't record the dividends across our funds. We did receive some in the month, but they're automatically reinvested and it reflects in what we call a higher accumulation price of the unit. So we don't record dividends. For the year to date, we have received £3,211.71 in dividends. Thanks to increasing share prices, the yield across the 9 shares is now being showing at 3.71%. Let's dive into the holdings within our portfolios. So we do own shares. So at the moment we own £79,610 in shares, makes up 80.9% of our portfolio, of which 69.3% is in the FTSE 100 and 11.6% is in the FTSE 250. And across the 15 shares, somewhat recovered during the month, 9 in profit, 6 in loss. Now during the month we did increase an existing holding. We purchased 104 shares in Legal and General at a cost of £248 on what we call a regular investment day, which is a flat fee of £1.50 no matter what value we make. But it was done to increase an existing holding and it's currently giving a very nice yield of over 7%. So let's look at the following chart about where our investments are. Now I'm not going to go through all of them, it's just a summary of the biggest, shall we say, and recent notes during the month. So our largest holding is Aviva, the insurance company. £19,200 makes up 19.5% of our portfolio. Safe, secure, steady, gives a very nice yield, currently around about 6%, but a long-term hold. Our next holding is Lloyds, 33,000 plus shares, £15,500, nearly 16% of our portfolio, and hopefully the banking sector will recover. Okay, we've got an impending recession, but interest rates have gone up, margins have increased, hopefully profitability will be increased, and who knows, hopefully increased dividends. Our next holding is Drax, the biomass oil pallet maker. 1,206 shares, £7,300, 7.44%. Has struggled in the last few months, has recovered during the month because of sentiment against, shall we say, fuel providers, but a long-term hold does have a very good yield, is very cash rich. Our next holding is Greggs the Bakers, 278 shares, £6,500, 6.5% of our portfolio. Again, very cash rich, everyone wants to eat, but it has been struggled by increased inflation. Costs, wages have been shooting up lately, but very good profits, very cash rich company. Our next holding is HSBC, 1,076 shares, £5,500, 5% of our portfolio. It was done away from the UK banks for diversification, but a very good company. It was paying a very good dividend. And again, another banking stock, Barclays, 2,941 shares, £4,700, nearly 5% of our portfolio. Again, like Lloyd's, very good results. Interest rates are up, profit margin increased, so hopefully some very good dividends payable next year. Our next holding is one we've increased recently, Legal & General. We now own 1,835 shares, £4,600, nearly 5% of our portfolio. But just like Aviva, safe, secure, everyone needs insurance, has got across numerous asset sectors, shall we say, but it is paying a very nice yield, which is safe, of 7%. And then two other shares we own, quite topical during this year, shall we say, Royal Dutch Shell, £3,500, and BP, £2,700. Has struggled recently because of, shall we say, the gas price or the oil price has been flattening, but it will pay some very nice quarterly dividends during the month of December. Now, other shares we own, JD Sports, the retailer, £3,100, has a very good value in the month. And Sainsbury's, 2,613 shares, okay, makes up nearly 3% of our portfolio. Some very good results out recently, and it will pay a very good dividend during the month of December. And other items, shall we say, is Penn and the Water Company, AG Bar, the drinks retailer, which has just made a new acquisition. But two items of note during the month: Card Factory, some excellent results, profit margins improved, profit forecast and guidance increased, and the share price was languishing around about 48p. It's now up to 75p in the month. And AJ Bell, some very good interim results. Assets under management has grown, customers has grown, dividends being increased. So quite a good month across our 15 shares and a very good recovery play. But all the shares were bought for long-term holds. We will increase existing holdings and we have no plan to sell any of them shares in the short term. Let's turn to the funds or the ETFs held within our portfolio. Now, at the moment, we currently own 6 funds, 4 in profit, 2 in loss, £18,821 across the 6 funds, makes up 19.1% of our portfolio. It was done because we were solely UK based originally. It was done for diversification, shall we say, and give us great exposure across a greater number of shares. We look at the following chart, just a quick overview of what holdings we own. So our largest holding is a Legal & General Technologies Fund, owns about 270 shares, £6,240, 6% of our portfolio. Technology has struggled during 2022, but a long-term, shall we say, hold within the portfolio. Our next holding was showing a very nice profit till recently, has struggled in America, but it's a US smaller companies. £3,753, makes up nearly 4% of our portfolio. Our next holding is quite selective, Bally Gifford Positive Change, owns about 35 companies, what we call ESG, okay, or environmentally friendly. £3,400, nearly 3.5% of our portfolio. Our next holding is a Lindsell Train UK Equity Fund, £2,700, 2.7% of our portfolio, but it was done very good select companies within the UK, shall we say, but it was done for diversification across big players within the UK equity market, and it's got an excellent track record over the last 10 to 15 years. Our next holding has struggled recently. It's a global growth fund, £2,000, 2% of our portfolio, but it was bought originally for diversification away from the UK, but we see no reasons why we'll sell the fund, although it has struggled. Hopefully markets will recover. And then finally, are UK smaller companies. Now normally UK smaller companies will outperform larger companies. We did put £1,000 in. It's now worth £727, so a loss of nearly 30%, but thankfully it makes up a very tiny percentage of our portfolio. But just like our shares, we've got no reasons why we're going to sell any of them funds within the short term. They're all done for a reason. Okay, so some of them have struggled, some of them have recovered during the month. Okay, but they were bought for a specific reason. And it was bought for diversification because we were solely UK based, and we may well increase those holdings over the next 12 months. Now remember, this is my own personal opinions, okay? It's not a get rich quick scheme. The aim is a 10% return year on year, annual dividends of £4,000. We have struggled during this month, but past years we have made 10%. But it just goes to show market sentiment. There will be good years, there will be bad years. Remember, if you like the videos, smash the like button, subscribe to this channel, and we'll see you again in the next video.